Welcome back. In this session, we're going to have a look at our second primary financial statement, being the statement of financial position. Sometimes you've heard it referred to as the balance sheet, but in the exam, it will be referred to as a statement of financial position. Now, this is your second primary financial statement. In the first financial statement, the statement of comprehensive income, we had a look at all our income and expenses that happened in the accounting period. With the statement of financial position, we'll be looking at our other three elements of the financial statements: assets, liabilities, and the owner's capital, which we will see later on will sometimes be referred to as equity. Now, when we think about a statement of financial position, it's always a snapshot at a moment in time. Look at the word position. What is the financial position of the entity at that year-end date? So what does the business physically own in assets? At that moment in time, what do they physically owe in liabilities? And ultimately, we would also want to show at that moment in time what the proprietor's funds were, the owner's capital. So, snapshot, as at, it's like a picture. So like I said in the last session, a statement of comprehensive income is a video recording, just like this. With this financial statement, it's a still picture, snapshot. All right? So, bearing that in mind then, we need to really think about what is an asset, what is a liability, and what is capital. So I thought we'd start off by having a look at those definitions. Now, with these definitions, at this moment in time, we've kept them very simple. Towards the end of this course, we will be looking at the IASB, the International Accounting Standards Board's definitions, the technical and accurate definitions for assets, liabilities and capital. But we've simplified it here just for ease of understanding at this moment in time. So let's start with an asset. Now, an asset is something owned by the business and is also available for use by the business as well. So, an asset, something owned by the business and is available for use by the business. Okay, so a simplified definition at this moment in time for an asset, something that we own. Now, the opposite thing to an asset would be a liability. So let's define what a liability is. A liability is something owed by the business to someone else. For example, if let's say I'm an owner of a business and I want to take out a business loan with the bank, and the bank is going to lend me that cash, but ultimately I have got to repay that loan to the bank. I owe that money to the bank, and obviously I'd have to pay some interest on that as well. So, a liability. Something owed by the business. In other words, amounts owed by the business. So, there we have it. We have our definition for an asset and liability. They are the first two elements to the statement of financial position. Our final element is capital. Okay, capital. Now, capital is amounts invested into the business by the owners of the business, sometimes referred to as the proprietor's funds. So, Let's write that down. Amounts invested in the business by the owner. Okay. So in later studies, particularly when we look at limited liability companies, capital will turn into the word equity. So do be aware that capital is another word for equity. And we shall see that word equity again later on in our studies. But there are three components to the statement of financial position. Now we've defined them, let's have a look at what the statement of financial position would look like and giving some examples of those three different elements. So, going then to our notes, let's have a look at this snapshot at a moment in time of those assets, liabilities and capital. Now, because I said it was a snapshot, refer to the title. Statement of financial position as at. That's very important. As at. Snapshot at a moment in time of the company's or businesses, assets, liabilities and capital at that date. And in this example, we can see that the date is the 31st of December 2009. Now, with the statement of financial position, this time we have three columns. Okay, three columns. And with these three columns, you can see we've got some headings at the top. Cost, accumulated depreciation, and the carrying value. Now, carrying value, sometimes you might see it referred to as its net book value. Okay, net book value. Now, these three headings of these columns only really apply to the first heading in the statement of financial position. And that's going to be non-current assets. Now, a non-current asset, remember an asset is something owned by the business and available for use by the business. Non-current means that we're going to keep that asset in the business for a period greater than 12 months. So, it's a resource or an item that we're going to keep in the business for a period greater than 12 months. Okay, that's what we mean by a non-current asset. And like I say, the headings of those three columns, cost, accumulated depreciation, and its carrying value, well, that really only applies to this first heading, non-current assets. So, let's have a look at some examples of non-current assets. What we can see in our list then, we have property. So this is your land and your buildings in a business. So you may own the land and the building that sits on the land as well. Now that building you might use and run all your accounts department, your administration department, and various other functions of the business may run out of that property which sits on the land. Now, with property and buildings, it's generally accepted that we're going to keep that for more than one accounting period, a long-term asset. So when we record our property, and for the time being we'll just think of it as buildings, we're going to record it at our original cost. So the original cost to the business, the physical price I paid to acquire that asset. So we can see here that would be 150,000, okay, or 150 million. Now, as time passes, the value of that building may depreciate. Now, depreciation is just an accounting estimate as a means of spreading the cost of the asset over its useful life. So maybe we think we might keep that building for 50 years. And we may have had that building in use for several years already. As time passes, that asset may go down in value and depreciate. Now, we've got a whole section devoted to depreciation later on in our studies. So we'll have a look at this idea of depreciation later on. For the time being then, if we take the original cost of the property and minus the accumulated depreciation, that is going to give us the carrying value or net book value of that non-current asset. Remember, a long-term asset. We can also see that there's some other examples of non-current assets. So we can see we've got plant and machinery. You may use your machinery as part of your main trading activities in your business. So maybe your property is your factory. And in that factory you have various machinery that you use to manufacture goods, which you will then sell in your business to earn you that sales income. Now, again, it's going to be likely that we're going to keep that machine for a period greater than 12 months. And if that's the case, we're going to record it at its original cost minus any accumulated depreciation to give the carrying value. Finally, then, we have motor vehicles. So again, we'll record the motor vehicles at cost. Now, motor vehicles definitely depreciate in value. You know, as soon as you drive that motor vehicle off the forecourt, it's already lost value. So we're going to have definitely some depreciation there that's accumulated, and then to give the carrying value. At that point, then, you can see that we've totaled off and closed the cost and accumulated depreciation columns for all those assets. We've also totaled down the carrying value column, but notice I've left that value 184,490 not underlined. We've left it open. And that's because we're going to have some other assets that we're going to add to that value, the sum of our non-current assets. So let's have a look at our other form of asset, which is known as a current asset. Now, current assets are short-term assets. They're assets we're going to keep in the business for a period less than 12 months. Okay, so short-term assets. Now, with your short-term assets, then, we do have some typical or some usual suspects. Our first one is inventory. And inventory is our stock in our warehouse at the year-end date. Now, if it's at the year-end, that must mean that that is our closing inventory. Do you remember we talked about that in the last session? Closing inventory. It's one of those unique items that appears both in the statement of comprehensive income as a deduction from cost of sales and in the statement of financial position as a current asset, something that the business owns. So, closing inventory, that's what we're going to record and put in the value of in our statement of financial position as a current asset. We assume we're going to sell it in the next 12 months, so we're not going to keep it for very long. Our next item is trade receivables. Now, trade receivables are people who owe the business money. So, if I sell goods on credit and I sell it to a customer, and I say to the customer, don't pay me now, pay me in 30 days, well, essentially that customer is a receivable. Okay, we are due money from that customer within the next 12 months. It's an asset, it's a good thing for the business. They are going to receive cash in the future from that customer who is promising to pay us later. So let's write that down. Trade receivables, people who owe the business money. Okay. So trade receivables, people who owe the business money. So that's also an example of a current asset. Let's have a look at our next example. And our next item in current assets is prepayments. Now, as the name suggests, a prepayment is if we've paid in advance. So maybe we've paid next year's rental cost now. So we've paid it within this year end. Now that's a good thing to the business, because if we've paid next year's rent in advance, well, that means that we don't have to pay as much cash next year to settle that expense. So prepayments are expenses paid in advance. And that's a good thing, expenses paid in advance, because like I say, we don't need to pay cash in the future. Now our final current asset at the bottom is going to be cash in hand and also cash at the bank. Now cash is one of your most important current assets. You need cash in your business in order to be able to survive, to pay your expenses, to pay any debts that you owe to suppliers or the bank, etc. So cash is, as the name suggests, cash at bank. It's an asset. Okay, it's something you own, and you can use that cash to buy more inventory. If you buy more inventory, you can then sell it to a customer. If you sell it to a customer and they promise to pay you later, it becomes a trade receivable. But then when that trade receivable settles their debt, you have the cash. So you have a whole operating cycle which works within this current assets heading. So what we do is we pop them in the subtotal column. So you can see now that these three columns, we are now essentially shrinking to two. So subtotal and then a total column. So we subtotal down, bring the total across into the end column, and we're going to add the total of our current assets to the total carrying value of our non-current assets, and that is going to give us total assets. And notice we've underlined 217242 because essentially we have done with the top half of the statement of financial position. All your assets, everything that the business owns. Now, we've seen assets, we've seen a lot of examples of assets. Now we've got to focus on our other two elements of our statement of financial position, capital and liabilities. So, let's take a look at this then. The second half of our statement of financial position, we're going to start off with the heading capital. Now, capital, as I've already mentioned, is the proprietor's funds, amounts invested in the business by its owner. Now, ultimately, that owner is going to want their money back, and they're going to want to take out money from the business. And usually that will be by way of them drawing money out of the business. Now, what the owner is going to do is invest their own capital into the business, and then they're going to draw money out of the business. But they won't generally draw out their own capital. What they'll do is draw out their profits. So, when we think about the proprietor's funds or the capital of a business, it's made up of three elements. The opening capital, the amount the owner has physically put into the business, plus the profits that the owner has made in the year, and that would come from our statement of comprehensive income. And then we would minus any monies taken out of the business by the owners of the business. So, looking at that then, we have the heading capital, and we're going to start off with opening capital, amounts invested in the business by the owner. So amounts invested in the business by the owner. What we're then going to do is add the profit that the business has earned in the year. So, why else do you set up a business? To generate profits and to make a bit of a return on that capital that you invested in the business. So we're going to add profit to the owner's capital because that's going to benefit the owners of the business. Now that profit is going to come from your statement of comprehensive income. So, remember how I said that a statement of comprehensive income is abbreviated to SOCI. Okay, that's your net profit or your profit for the year, and that's what you're going to increase the owner's capital with. Finally, then, what we're going to do is deduct drawings, amounts taken out of the business by the owner. And what we'll do is we'll take capital plus profit minus drawings, and we can see then that we'll bring the total across to the end column, 168,352. Our final element of the financial statements then is liabilities. And just like with assets, we split them into non-current liabilities and current liabilities. We're starting off with non-current liabilities. That is amounts that we owe to people in a period greater than 12 months. So as obligations falling due in a period greater than 12 months. Your long-term debt. So, who would you owe money to in the long term? Well, generally that would be a bank loan. Okay, so if you take out a 25-year bank loan, then yes, that will be a non-current liability because it's due for repayment in full over a period of 25 years. So loans from the bank, we can see there $20,000. There we go. There's not really very many of the non-current liabilities at this level, but loans and mortgages would be typical items that you would see. Finally, then we have current liabilities, that is obligations falling due in a period of less than 12 months. Okay, so people who we owe money to in the next accounting period. Well, the first thing we could have is trade payables. So if we purchase goods on credit and we promise to pay the supplier later, well, we have got to pay that supplier, let's say, within 60 days. Well, that would be a current liability. So, trade payables, suppliers, who the business owes money to. So, we owe that money to that supplier. Our final item then is accruals, or accruals. Now, an accrual is opposite to a prepayment. We said that a prepayment was an asset because it was expenses we paid in advance. Well, with an accrual, it's an expense due but not yet paid for. So an accrual is an expense due, not yet paid for. So maybe we've consumed an electricity amount in the last month of the year, so let's say December, but we haven't yet received the bill yet from the electricity board. We might not receive that bill to January or February. But we know we've consumed that electricity in the period, so we know we're going to owe some money to the electricity board in the future. As a result, an accrual adjustment would need to be made. And again, we're going to have a whole section of the notes looking at these accruals and prepayments later on. So, subtotal our current liabilities, bring the total across. That's going to give you 28,890. You are going to take your capital of 168,352 plus your non-current and current liabilities, and that will give you total capital and liabilities, and that would be the bottom of your statement of financial position, now complete and underlined. Notice then that the total capital and liabilities figure is precisely the same figure as total assets. So your assets must always equal your capital and liabilities. Everything the business owns in assets must equal everything the business owes in liabilities for also owing that money back to the owner through capital. And that's why it was used to be called a balance sheet, because both the top and the bottom half would balance. But it's now known as a statement of financial position, which I refer to in this course sometimes as SFP for short. So then, they are our two primary financial statements, and in the upcoming sessions we'll be looking at preparing these ourselves. But it's really important that you make sure that you learn these pro formas early on. They will serve you really well when we understand the impact of certain transactions and events on these financial statements. Now, just as a final note before we finish, there are two more financial statements that we would be asked to prepare in this syllabus: a statement of cash flow and a statement of changes in equity. We are going to see these other two financial statements in later chapters. So don't worry, we're not going to miss them out. We're just going to study them later on. Okay, so thank you.